My name is Udit and I work in Germany as a finance manager. In my first video on this channel, I had talked about the biggest barrier to starting your investment journey is not being able to open a trading or a demat account. After we have our demat or trading account in place, the next biggest barrier that we have in our investing journey is finding the right stock or ETF or the asset class to invest into. And here we are paralyzed by the paradox of choice. What is the paradox of choice? It says that once we have a lot of options to choose from, our ability to make the decision goes down substantially. And this is exactly what happens in our investment journey. We are overwhelmed with the number of choices that we have: small cap, mid cap, country A, country B, large companies, small companies, tech companies, pharma companies, FMCG companies, where to invest, where not to invest, what is happening in the world. Because of so many choices that we have, we are overwhelmed. And then what do? We start seeking tips from our friends and family members. This defeats the overall purpose of our investment journey. The purpose of starting and continuing on the long investment journey is to be in control over our finances. What happens when we take tips from our friends and family members is that we lose control. We are not in control over our financial decisions that we are making for the rest of our lives. And in most of the cases, we end up losing money if we go ahead by taking the tips from the friends and family members. Now, since our capital is limited, we have only a limited amount of finances. We have to make the best decision out of them. We cannot buy it all. But here's the catch: the financial world is very smart and very creative. So let's go back to 1976 when John C. Bogle, the founder of Vanguard Investment Group, came up with this idea of index funds. What he did was he invented a very simple product wherein someone can invest a very small amount into an index. And what is an index? Index is a basket of companies in a specific geography which is listed by market capitalization, or in simple layman terms we can call it the value of each company in the market. And then what happens is somebody invests a certain amount, and this amount is invested proportionately in all these companies in the proportion of their contribution within the index. So basically, if there are three companies in the index comprising 20%, 50%, and 30% in value, if you invest 100 euro in those companies in that index, then your money is allocated in the same proportion, which is 20 in company A, 50 in company B, and 30 in company C. And as the companies move in and out of value in this index, the amount of money that is invested further into these companies varies in the proportion of the composition of these companies in the index. So it is a self-correcting mechanism which takes care of companies coming in and going out of the index. And this is a very simple way to start investing. So if you are confused about how to start and which stocks to invest, just look at major markets in the world. You have large indexes like S&P 500, which represents the top 500 companies in the United States. You have FTSE 100, which represents top 100 companies in the London Stock Exchange. You have DAX 40, which represents the top 40 companies listed in Germany. You have NIFTY 50, which represents top 50 companies listed in India by market capitalization. And you can choose to invest in these indices or any other geographies or indices of your choice. It is very simple way to get started, and it is also diversifying your portfolio from day one. Your money is not concentrated into a specific company, and it is fairly diversified. And also, since it is a self-correcting mechanism, what it does is that the companies which move out of value, the investment in those companies goes down, and as a company moves out of the index, your money is no more invested in that company. Similarly, if a new company grows and comes into the index, your money is automatically invested in that company. So over a long period of time, this is a very good way to continue your investment journey. And there has been a research which was conducted by S&P Global, which stated that 90% of the actively managed funds were not able to outperform a simple index fund over a 20-year period. So, if you're wondering how to get started with your limited capital, your first 100 euro, your first 1000 rupees, your first 10,000 rupees can be invested in an index fund, and you can continue this for a longer period of time. So, thanks to John C. Bogle, we have a product which is fairly simple to understand and is investor friendly. One thing that we have to keep in mind while choosing a certain ETF or an index fund is the management fee. So, the asset management company which is providing this product of an index fund charges a small management fee for running this product. And you have to ensure that this management fee should be as low as possible, because this would eat up into your return. A rule of thumb which I personally follow in my investments in indices or in ETF is to have a management fee less than 0.5% of the total assets under management. So if I'm investing 100 euro, I should pay less than 50 cents per year as a management fee on the amount that I've invested. So we have to be careful in terms of choosing the right fund with the optimum expense ratio or the management fee, and this is going to help us go a long way in our investment journey. So friends, I hope I was able to simplify this concept of ETFs and index funds for you in this video. If you like my videos, please share with your friends, subscribe to the channel, and in the comments let me know what all subjects do you want me to talk about. And remember, like I always say, in investment journey or career or life, the most important aspect is moving forward in the right direction. So for that, we need to keep walking and remember that growth is life. Thank you.